Greetings, it is time for our monthly monetary creation update, which is one of the most popular series of videos on this channel. It's always a reliable, high traffic video when I post this because it is the essence of what I have discovered in terms of the connection between technology and economics. And while the number of people who believe in this connection, despite how much evidence I present, is still small, at least it is growing through this channel and through the efforts of all of you watching this and who point others to this material. So we begin with this Yardeni report like we do every month, and we scroll down. First over here, these are the cumulative amounts of quantitative easing, money printing if you will, by the four major central banks of the world that comprise about 85 to 90% of all of the money printing being done in the world. The biggest central bank not included among the big four is the Bank of England. The US Federal Reserve is the red line, and as you can see, it is not even the biggest money printer. The blue line, the European Central Bank, was bigger for a long time. They have tightened more, so they have come down to the same level as the United States. But nonetheless, the U.S. Central Bank is only a little more than 1/4 of the grand total. It is only 8.8 trillion out of what we'll see as almost 28 trillion in a couple of minutes. So when anyone says that the U.S. printing money is somehow going to cause hyperinflation and the price of gold to go up, that is crazy because they are, among many mistakes, implying that the United States is the only country in the world, and certainly the only country that is printing money, and that is not true. All these other central banks have been printing trillions upon trillions of dollars as well. The European Central Bank, which is blue, the Bank of Japan, which is green, and the People's Bank of China, which is the orange one. So don't listen to people who say that the U.S. Federal Reserve printing a lot of money is why there's hyperinflation or why gold will rise. And gold has not risen over the 12 years that this quantitative easing has been going on, as I speak about often in this channel. Because these are people who are assuming that the U.S. is the only country in the world. They may academically know that there are other countries in the world, but when they get down to finance, their brain just shuts off. So don't listen to them. Now, since money printing is borderless in terms of its impact on the broader macroeconomy, the measurement that makes sense is to see all four of these printing trends as a summation. And that's why we have this chart over here. This chart is just the sum of the four central banks that we saw before, and 27.9 trillion has been done to date. This is below the peak, which is over 31 trillion, so they've already tightened a good 3 trillion plus since the peak. Now notice how this grand total is in an exponential trend, and this is what I maintain is a long-term trend. When technology became a sufficient part of the economy for technological deflation to distort traditional macroeconomic statistics and require money printing, as well as a Fed funds rate of 0% in the United States and the equivalent 0% rate on the front-end rate in Europe and other major economies. And this has to be exponential. I claim this has to rise 16 to 24% a year, and this exponential curve is quite evident. Also consider that since the beginning of 2018 to present, so almost 5 years, there's only been 7 trillion more printed. The four major central banks had already printed 21 trillion by the beginning of 2018, and there was not high inflation then. There was not high inflation even in 2019 or 2020. Since that time, there's only 7 trillion more that has been done. So in 5 years, only 7 trillion more, meaning 21 trillion going to 28 trillion. Doesn't sound very overwhelming or very excessive. So all this talk of inflation is greatly exaggerated, and what little inflation we see is not because of quantitative easing that I explained many times, and I'll also explain later in this video in part 2. If going from 21 trillion to 28 trillion in 5 years, 7 trillion more in 5 years is the cause of inflation, then nothing that has happened prior to the beginning of 2018 makes any sense at all. Again, the media likes to scare people and likes to oversimplify messages. Therefore, the vast majority of what you hear about this subject is very ignorant and very oversimplified. And you have to tune all of that out. So now as we see they are tightening, which is something I say they should not do, what does that mean for its impact on the markets and the fact that this number is too far behind the trend line? Just for the amount of money printing to get back to what the trend line says it should be, they would have to do 4 or 5 trillion in a very short time just to get back to where they're supposed to be. If they were to get back by 2024, they would have to do 10 trillion in the next 2 years just to get back to where they're supposed to be, because otherwise technological deflation is too much and there's insufficient liquidity to offset that technological deflation. Now let's look at the same chart in its year-over-year growth rate. Now remember, I say that this should be in 16 to 24% a year growth at all times. Only sometimes does it reach the lower end of that band. Most of the time, they are trying to tighten because the Federal Reserve still thinks that money printing should be reversed. And they keep tightening, and that causes a stock market correction that forces them to print more than ever before, and then they overshoot again, and they over-tighten again. They tightened in early 2019. That caused a major stock market crash then, so they printed more. And whether COVID happened or not, they would have had to print. They got the year-over-year rate all the way up to 46.3% in February of 2021. That is a level at which even I say there would be some inflation, but that was for a very short time, and there was no aberrant inflation in February of 2021. So they started to tighten, and whatever inflation we're seeing right now, it's for reasons that I will describe later in this video. It's not because of quantitative easing, because it doesn't line up time-wise or quantity-wise at all. It is because of overt government actions in the United States to shut down domestic oil and natural gas production, as well as consistent supply chain mismanagement. And therefore, the tightening now shows a growth rate of minus 9.3%. It should always be in plus 16 to 24%. It should be in this band around here, and now they're at minus 9.3. That's the deepest rate of tightening they've ever done. The last time they went even somewhat as deep, down to minus 6%, there was a major stock market correction, and the same is going to happen right now, as I describe in other videos on this channel. They're over-tightening because they overshot over here. Think of it this way. The PhD economists running the Federal Reserve, imagine if you had a person in your care. The right thing to do would be to feed them the right type of food and the right quantity. Instead, what the Federal Reserve does is overfeed that person and then induce vomiting. And then overfeed that person again and then induce vomiting again. And if that were not bad enough, they're also feeding that person the wrong type of food. When I say the wrong type, what the Federal Reserve does is buy treasuries and mortgage-backed securities. That is only two types of instruments, and that has caused a tremendous distortion in just those two instruments, which not only causes all decision-making in the economy to be greatly distorted, but major financial institutions are forced to create a business model dependent entirely on front-running the Federal Reserve. All classical financial decision-making has been subordinated to front-running the Federal Reserve. You hear about BlackRock buying up residential homes in the United States. Well, what do you expect them to do? That is the most obvious way for them to make money, because the Federal Reserve is artificially boosting the housing market and then artificially making it crash by unwinding the purchases of mortgage-backed securities that they did. It's quite crazy. And this is a complicated subject, but I think that metaphor simplifies it down. Instead of feeding a person a normal and regular amount, and that too of the right type of food that would be healthy for them, the Federal Reserve is overfeeding them and then inducing vomiting and overfeeding again and inducing vomiting, and that too with the wrong type of food. I mean, I cannot make it any clearer than that about how bad of a mismanaged system they have, because those PhD economists don't understand the first thing about the modern technological age. They only have memorized textbooks from about 70 years ago and are incurious about why those models aren't working anymore. Now we go to this last part of summary. Now this is the same four lines we saw earlier, but as a percentage of each entity's GDP. Again, so when people scream about the US Federal Reserve has printed $8.8 trillion and that is going to cause hyperinflation in worldwide price commodities, the United States is the joint lowest of the four in terms of a percentage of US GDP. The US is the joint lowest with China out of the four. Europe has printed twice as much as the United States in relation to the size of the Eurozone, the collection of countries that use the euro as a currency. Germany is the largest country in this group. Now, you would think Germans are the ones who are most afraid of money printing and the prospect of money printing causing inflation, but nonetheless, they have done the right thing by printing twice as much money as the United States. Nobody says that Europe has super high hyperinflation for any reason other than the war between Russia and Ukraine. But the greatest of all is Japan, which has done twice again as much as Europe. Japan has done 134% of its GDP in money printing. So 4 times as much as the US, also 4 times as much as China. And even the people who claim that the US has high inflation and that the US government deliberately underreports inflation, even those people don't claim Japan as high inflation. So how can Japan print 4 times as much money as the US in relation to the size of its economy and still not have any aberrant inflation? In fact, they still struggle with deflation. If you can't explain that, you don't know what's going on. So don't say that the US Federal Reserve is causing hyperinflation when Japan has called the bluff of this bogus hyperinflation narrative by printing 4 times as much money. They have done a tremendously good service for humanity by calling this bluff, and the Bank of Japan deserves tremendous praise for doing that. Now, before we end part 1 of this video, we're going to go to my scorecard. This is my scorecard of my prediction on January 1st, 2020. Now, in the 2010s decade, as we just saw, the 4 major central banks printed about $23 trillion of money. All the PhD economists in the world not only believe that printing was a temporary phenomenon, they believe all of it will be reversed in this subsequent decade, the 2020s. Therefore, their prediction for the amount of money printing between January 1st, 2020 and December 31st, 2029 is minus 23 trillion. They actually think that the first 23 trillion will be undone, despite everything we saw about that exponential trend of cumulative money printing and the calculations I have presented in a lot of places about how that matches up with world technological deflation from the ambient technonomic medium of the world. They say minus 23 trillion. Whereas on January 1st, 2020, I said that no, this decade will have much more money printing than ever before, and this is a very good thing because it shows that there's more and more technological deflation that can be monetized for human prosperity. So I said plus 50 to 100 trillion will be the amount printed between January 1st, 2020 and December 31st, 2029. 50 trillion if it is done in the form of cash directly to people, which is what it should be, because that would comprise the right type of food being fed to a person in your care under that metaphor from a few minutes ago. $100 trillion if it is still done in the form of treasuries and mortgage-backed securities being purchased. That system will break, but they will also have to do more money because of the non-diffuse nature of that type of money printing. So 50 to 100 trillion depending on type. So what has happened in the 2 years and 10 months since January 1st, 2020? So more than a quarter of the way through this 10-year period in question. Well, the amount of money printing done is plus 8 trillion. Plus 8 trillion is what is done. And remember, this is exponential, so it's not going to be linear. Towards the end, the amount done per month and per year will be much higher than in the early parts of this decade. But it seems like it's trending closer to what my number says it would be rather than what all these decorated PhD economists, thousands upon thousands of them, collectively think, which is all quantitative easing will be reversed and that the Fed funds rate will be at 3% as a normal equilibrium, when in fact it should be at 0% and what it will soon be before very long. So their prediction is already trending wrong. I knew it would be wrong because I said this on January 1st, 2020. And remember, it doesn't matter how many PhD economists they are because they've all memorized the same thing. So whether there's just one of them or 10,000 of them doesn't matter because they've all memorized the same thing. A PhD economist in the United States is the type of person who is happiest when they're in a room of 6 people who have exactly the same opinions as them and they just repeat back to each other what they have memorized. That is when those people are happiest. They don't want any outside perspectives. They have absolutely no interest in learning why the models that they memorized from textbooks written 70 years ago are wrong. They have no curiosity about that. They are very analogous to the mechanical engineering establishment who, as late as 1901, insisted that heavier than air flying machines are impossible. And PhD economists are so theoretical that they are the equivalent of if the mechanical engineering establishment insisted that heavier than air flying machines are impossible, even as of 1945, even after all World War II had happened. That is how out of touch and in denial of reality these PhD economists are. They're truly the flat earthers of our age in terms of economics. It's astonishing. It's something that history will look upon very strangely, in that how was economic policy making entrusted to people who are so hyper theoretical? But this also means that major historical turning points are imminent, because whenever this situation arises historically, there is a major shatter point of the existing order and something much better has emerged and much greater prosperity for people who were previously being held back by the misguided policies of PhD economists. So what is inflation actually at? For that, we go to part 2 of this video, so let's continue to part 2. Now, as always, inflation dominates most of the financial media and even the non-financial media because the media has a vested interest in making you angry or frightened. Therefore, they have convinced a large portion of the population that A, inflation is always bad, and B, that inflation is much higher than it really is. And this is dangerous because a lot of people are being habituated into believing that deflation would be good and a politician that runs on deflation could get votes. And deflation is a lot worse than inflation for the reasons I explained in this video that you see in the upper right hand corner over here. Deflation is far worse than moderate inflation. But the media is in the business of making you angry or frightened. Always remember that. So we go over here to my multi-dimensional inflation measurement, which takes into account 3 different metrics. The 10-year compound annual growth rate of the US CPI. We take 10 years to smooth out any short-term noise. The 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and this is the most important measurement of the 3 because A, this is worldwide, B, this cannot be rigged because it comprises of commodities that are freely traded daily. One of the narratives that is pushed among all the people trying to scare everyone about inflation is that the US government underreports inflation rates. That is not true because the Goldman Sachs Commodity Index is not something that can be rigged, and the United States is not the only country in the world. A lot of inflation mongers and gold bugs seem to think that the United States is the only country in the world. And the third measurement is the 10-year US Treasury yield. Now, this is a measurement of future inflation expectations. It is not about the past or even short-term rates, but it is a measurement of future inflation expectations, and it's also the 10-year note that I take because that is the most issued US Treasury within the long end maturity of the US Treasury yield curve. And I choose 3% across all of these, even though a 10-year Treasury yield of 3% is extremely low by historical standards. But we are in an age of technological deflation, and it's even hard for this number to be above 3%, let alone the US CPI 10-year compound annual growth rate, or the Goldman Sachs 10-year compounded annual growth rate. So now we shall see what each of these 3 measurements are. So as always, for the US CPI, we go to the bls.gov website, which will be in the description box below, and we go to Consumer Price Index, clicking on this little graph icon over here. So in the formatting options, we want to check a variety of time windows and measurements. So we choose the absolute data value. We don't choose 1 month, but we choose 2, 3, 6, and 12-month percent change. So we retrieve data. Now over here we can see the actual CPI, and it looks like it's rising, but remember, this is an exponential measurement in a linear vertical axis chart. So the way to calculate the 10-year compounded annual growth rate is to take this number, 297, divided by the number exactly 10 years prior, 232, and then take the 10th root of that number to get the annualized number. So 297 divided by 232, 1.28, so 28% inflation over 10 years. So per year, that is x to the y power 0.1, the 10th root of 1.28. I hope everyone understands the arithmetic about how that is done. 1.025, so 2.5% a year remains the CPI annual growth rate over this 10-year window. And the 10-year window matters. The people who want to say that inflation is high, they are very selective about what starting point they tend to take. I am consistent in taking the 10-year window, and that means current slightly high inflation that may be popping up for a couple months is also going to be in this 10-year window for a long time. Now, is this moderating? 2.5% a year. But see, this is a 2-month percentage change. That's already past its peak. The second derivative is already gone for that. And we see the same thing in the 3-month percentage change. The second derivative is already gone. Doesn't mean it can't come back, but it takes a lot for that to come back. In the 6-month window, the second derivative has moderated substantially, and the annual CPI measurement is already peaking over here. It's still above 8%, but that 8% has to be weighed in accordance with the times when it was close to zero, like over here in 2020, the start of the COVID-19 pandemic, and all of 2015. That's when we were slipping into deflation. So you have to take the average of all of this to get a holistic picture, and 2.5% a year happens to be the average, as we just saw. The media will tell you inflation at 8.3%. Yeah, but they are taking exactly only this 1-year measurement. When it falls, they won't be anywhere to be found. This is the annual trailing 1-year measurement, but the average of 10 years from here up to here October of 2012 to September of 2022 is 2.5%. It can thus fall off as quickly as it rose, as we saw from the earlier percentage change windows of the 2, 3, and 6 month charts. So the US CPI is growing at 2.5% a year. Next we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and the website link is in the description box below. And the 10-year average of the GSCI is minus 0.47%. Minus 0.47%. Deflation and a non-trivial amount of deflation. Forget inflation, this is in deflation, and this is, as I mentioned before, the most important measurement of the three, because commodities are what comprise what increases costs for people versus what decreases costs for people. Inflation also has a wage increase component tied to it, such as service price inflation, but that becomes more ambiguous. If inflation is high because of services price increases, that means someone's wage is also rising, and a lot of PhD economists don't understand that, hey, if service prices are increasing, the customer of the service is paying more, but the provider of the service is making more. So it's ambiguous about whether inflation is bad for whom versus not under those things. But within commodities, always lower is better. And this is in deflation, minus 0.47%. And I always take the 10-year window. Some people like to criticize and say that this is a plateau from which I'm taking a 10-year window, but it's a rolling 10-year window. And the peak price of oil was actually in 2008, $147 a barrel. It was not less than 10 years ago. It was in fact 14 years ago. Now eventually I'm going to take a commodities measurement equation because I will prove that we are reaching a point in the technological economy, the high-tech age, where no amount of money printing can make commodity prices rise at 3% a year. We are close to an infinity on that front. That doesn't mean that money printing can be infinity, because there's more to the economy than just commodities, but we are reaching one of these pre-singularity milestones when we talk about this. So Goldman Sachs Commodity Index, minus 0.47%. This is a bundle of everything: oil, natural gas, gold, silver, everything. And remember, to believe that gold or silver is going to rise after so much quantitative easing, trillions upon trillions upon trillions of dollars of quantitative easing failed to make them rise, means that a bet on any inert commodity, such as gold or silver, is effectively a bet against all technological progress, number one. And to believe that money printing could make gold and silver rise in price a lot is effectively to believe that no one ever made any money by producing and selling software. So to be a gold bug, you'd also have to believe that nobody actually made money in the production of software. So that is why being a gold or silver investor and expecting that to rise is reaching a point of intellectual bankruptcy, as I talk about a lot on this channel. So now we go to the third and final measurement, which is the 10-year US Treasury yield. So 10-year US Treasury yield, and yes, this one is actually shooting very high. It's 4.21%. That's well above the 3% measurement that I said. Notice how there was resistance at 3%, and it was below 3% for most of the last 5 years. This is a 5-year chart. But now it has shot all the way up to 4.21% and is rising still because the Federal Reserve is deprinting money. Quantitative tightening is going on, and not just the US Federal Reserve, but in all major central banks of the world, which is exactly what they should not be doing, as I explain quite often on this channel, because this is going to crash the US housing market, which will require more printing than ever before, but it will also require printing of a new dimension than was done before, because they can no longer just buy treasuries and mortgage-backed securities as a method to pretend they're not printing money when they're printing money, because they've caused different distortions in the market. Okay, so US CPI, Goldman Sachs Commodity Index, and 10-year US Treasury yield on today, October 23, 2022. And what is the answer? As we saw, 2.5% for the CPI, so still below 3% and moderating. It's going to take a lot for this to go above 3%. Goldman Sachs Commodity Index, it is in deflation. It's very volatile. It can move around quickly, but it's in deflation, nowhere close to 3%. And we are very close to an age in the history of human civilization where almost no amount of money printing, or even literally no amount of money printing, can make this go up at 3% a year under this measurement. And then the 10-year US Treasury yield. Yes, this one is well above 3%. It is a measurement of future inflation, but this is extremely bearish for the US housing market, as well as for the US federal budget deficit. It's very bearish for all that and is putting a lot of pressure on the stock market, which could cause a stock market crash, as I speak about in other videos on this channel, but also reduces inflation by a lot. So this getting higher puts a lot of pressure on these other two as well. So only one of the three metrics is above 3%. keep that in mind when everyone talks to you about inflation and uses very anecdotal evidence to prove that inflation is much higher. Remember, the rigor of their research about inflation is tantamount to saying that their wife's boyfriend's parole officer heard that the price of something rose and therefore we are about to die from hyperinflation. Don't listen to those people. If you found your way to this channel, you are way ahead of the curve and have a lot of resistance to the programming that the financial media is inflicting upon the masses. Now, if you like this type of content and would like to see more videos of this type, I encourage you to subscribe to this channel and hit the notification bell. Thank you very much for watching.